Good morning, everybody. My name is Jackie Ferrado. I'm the Community Relations Manager with the Washington 529 College Savings Plans, which is the GET program and the DreamAhead College Investment Plan. Thank you for joining me this morning for this webinar on getting to know the Washington 529 College Savings Plan. So appreciate you taking time out in your day to learn a little bit more about the GET program and DreamAhead plan. I wanted to give you a couple of housekeeping notes before I get officially started in the webinar. Like many of you, you're probably working remotely and from home, and so welcome to my home. So things I wanted you to know as I get started is that I've planned for the webinar to last approximately 30 to 40 minutes, which does include plenty of time for some Q&A. So if you have some questions that you're thinking about along the way, if you could put them in the Q&A box, my colleague Liz will be monitoring that box and excuse me, and will also be answering questions along the way, but I will be taking some time to glance at that too and then answering some of the questions live. We're going to have a slide at the end of the presentation with contact information. So if you'd rather wait, you can also send an email to myself or to our contact center teams for either the GET program or DreamAhead plan with your questions, and then we'll make sure that we're following up with you afterwards. If you're new to Zoom, you just hover around the bottom part of your screen and the Q&A box should show up there. We do have the chat box as well, but it would be easier to keep an eye on the questions if you're putting them in the Q&A box. But feel free to communicate any way that works best for you. We will do our utmost to get all of your questions answered today through the webinar, but again, we've got some resources if we can't do that. And the very last thing I wanted to mention before I jump right into the webinar content is that we will be recording this webinar, so you'll be able to refer back to it later for any questions or things that you might have missed. So if you're ready, I'm going to jump right in and get us started. I wanted to talk about an agenda, a little bit, give you an idea of where we're going to go with this whole presentation. So I'm going to start out with an overview and highlights of 529 plans, the GET program, and then DreamAhead. I'm also going to touch on the most frequently asked questions, the things that come up most often, and then 529 plans and financial aid. It's often a really good idea to get an understanding of how they interact, how they work well together, so that in your planning, you're understanding that piece ahead of time. And then we're going to wrap things up with some tips for saving, some other useful information, including some other ways that you may be considering saving that could go hand in hand with putting money also into a 529 plan. So that's how we're going to proceed through the webinar. And I'm going to start off with talking about what are 529 plans. Most of the time when I'm presenting this information, most people have heard of the term 529 plans. They even have a 529 plan, or they know the number. They've heard 529, but they're not quite sure what it all means and how it all comes together. So I'm just going to give you the overview on that, and it gets us all set to understand the information about GET and DreamAhead as I go into that part. So 529 plans are tax-advantaged college savings plans. And every state in the country will sponsor a 529 plan. So they'll either have what's known as a prepaid tuition plan or a traditional savings plan, and some states will have both types of 529 plans. So Washington has the GET program, Guaranteed Education Tuition Plan, which is the prepaid tuition plan, and then DreamAhead Investment Plan, which is the traditional savings plan. So you can have multiple 529 plans. You don't just have to have one type or from one location. You can have multiple ones. Maybe you do something different depending on each of your children. So there's nothing that prevents you from having multiple 529 plans and different types of 529 plans for any one or all of your children or grandchildren or people that you're opening up accounts for. So the thing about 529 plans, the tax advantage is that the earnings portion as money goes into a 529 plan, the earnings portion will grow tax-free, and then it remains tax-free when it's used for qualified educational expenses. We're going to talk about what those are in the next slide. But the next thing that gets commonly misunderstood is where your student can actually use the money from a 529 plan. And in fact, they can attend any public, private, community, technical, or vocational school anywhere in the country, including schools that are abroad in foreign countries, and now also registered apprenticeship programs. So that's a new thing that was passed late last year in 2019 in the SECURE Act. So now a student who is choosing a pathway of education that might be an apprenticeship type of program, you're able to use your money from a 529 plan to pay for expenses for that institute or that type of training. Now, the other two things are pretty much a given, but they're always worth making sure that we mention, and that's that anyone can contribute to a 529 plan. So parents might be the ones who open up the account, and grandparents and family members, even colleagues and coworkers and friends can be contributing to a 529 plan on behalf of your children or grandchildren. And the account owner, so the person who is named as the official account owner, the one who basically is the one who controls the account, they can decide at different times if they need to transfer money from one beneficiary to another. So some examples of the types of transferring that might happen would be student to student or child to child. So you might have one or two or more children or grandchildren, and when you start to actually realize how much one may need or how much another one does not, you can implement or initiate a transfer of money from one beneficiary to another. Other ways we've seen is where the parent themselves has decided to take on some additional educational opportunities, and so they can change the beneficiary to themselves, use some of the money, and then change it back again. The IRS does have some requirements on how often that can change, and I believe it's 1 year between transfers or changes. So you would want to be careful not to think you're going to do it for a quarter and then change it a quarter later. You would have to wait a 12-month period of time before you can change it again. And then another way that families have considered transferring is when, in fact, the student who was the original beneficiary maybe now is older, they've completed their pathway to education, and there's still money left in that account, you can be transferred down to a grandchild. So I took advantage of that opportunity with my children's accounts when they no longer needed the money that was in there, but now grandchildren were here for me. I took advantage of having that money transferred over to their accounts once their parents had set up the accounts for them. So that is 529 plans in a nutshell. One of the greatest resources I can give you here is the College Savings Plan Network, and that web address is collegesavings.org. And it is the independent source of all 529 plans. So it's a really good place to get a grounded kind of understanding of 529 in general, and then you can take a look from there at what the other states are offering as well. So now we're going to talk about those eligible expenses that I mentioned, and the typical ones are tuition and fees, and that's what the school will be charging, right? It does include K-12 private schools tuition, but some considerations in whether or not you'd actually use it for that or not. That was passed federally several years ago, that you could now use money from a 529 plan to pay for K-12 private school tuition. But the thing to think about is that how the transferability happens, and not all of the 529 programs are set up yet, and they certainly weren't designed at the time that the 529 plans were created for that type of transfer, but we have seen it happen. So if you have some questions about it, reach out afterwards and I'll connect you with some resources about what to consider there. But the other types of eligible expenses is going to be room and board, and that's on or off campus. So typically on campus is money that's going to go from the program to the school directly. But even off-campus housing is considered an eligible expense. The student needs to be registered at the institution or the school that they're attending at least half time for that to be considered eligible. And then there'll be some limitations on the amount that you could take back as a reimbursement so that it's considered eligible. And again, we can talk a little bit more about what those specifics are, and I can point you to a resource. So books and required supplies are also eligible expenses. And recently, again in December, in the Secure Act, it was passed that up to $10,000 of existing student loan debt can now be paid down from money that you have already saved in a 529 plan. And that's a really exciting new feature, because when it wasn't passed, before that passed in December of 2019, if you had existing student loan debt, whether it's one or two or more children in your family unit, you could withdraw your money from a 529 plan, meaning you'd take a refund, and then the refund would take a tax and penalty hit on the earnings portion, but then that's how you would pay it down. Well, now you can directly pay down a student loan debt up to $10,000, as it shows right there, without having to take it in the form of a refund. So I'm gonna move down to talking about GET and DreamAhead now more specifically. Now, what I've done here on this slide, you'll see, is I've lined up GET and DreamAhead next to each other. But the caution here is that it's not necessarily about comparing them and looking for, oh, which plan is better, which is, better or worse, is what I hear some people ask me sometimes, as well, which one is better? And it's really not a better than, worse than type of situation. It really is about finding the right fit, and that the type of plan that you're picking, or the choice that you're going to make, and whether it's GET or DreamAhead, is really lining up with the goals that you have, the preferences that you have, and other things to consider is like, how many children do you have in the family? How many children are you saving for? And how much are you able to be contributing? And certainly a risk tolerance. What is your preference in that respect? To how you want to save. So let's just talk about GET first. And GET is the prepaid tuition plan, as I mentioned earlier. Now, most typically, states that have a prepaid tuition plan will require an initial residency, which means that either the account owner or that student beneficiary who's named on the account has to be living in that state at the time that you open up the GET account. You can move anytime after, and then so can the beneficiary. You don't have to stay living here. It's just initial. As soon as you're opening up the account, either or has to be living in the state of Washington to open a GET account. GET also has an enrollment period, which runs November through May of every year. So today we're already at mid-May, so we've got a couple more weeks before this end of enrollment will be over for this year, which is May 31, and then we'll reopen again on November 1st, which will be the next cycle's enrollment period. Now, typically on the traditional savings types of 529 plans, so for Washington, it's the DreamAhead plan, there's no residency requirement, so people from anywhere at any time can open up a DreamAhead account for a beneficiary, and no enrollment period. So again, it can be opened at any time. Now, those are two typical situations that happen in the difference between a prepaid and a traditional savings type of 529 plan. Now, the next area that we're going to talk about is the growth and the value of an account. And this comes up quite a bit in conversations with people when they're wanting to understand the difference between how GET grows and how DreamAhead grows. And that helps in making decisions about what feels good to you and what your preferences are. Now, the GET program, when that one was designed, the state legislature built or wrote into law a guarantee that the value of the account, the GET account, will keep up with the tuition growth of the highest priced Washington public institution. So that's either Washington State University or University of Washington's tuition growth. So when you're putting money into a GET account, the value of it is keeping pace with the tuition growth of those two schools. But you remember I mentioned earlier that the kids can actually attend institutions anywhere in the country, including abroad, public, private, community, technical, and apprenticeship programs, but the value is keeping up with UW and WSU's tuition, and you can use that money at those other places, right? So the flip to that is on the DreamAhead side is that the value is tied to the investment return. So DreamAhead and Traditional savings types of plans look a lot more like your retirement plans are, where you're putting money in, choosing how you want it invested. You make the decisions on your risk tolerance and can make changes to that over time. But what's going to happen is that the value of it is just going to be dependent on the investment return. So there's not a guarantee on a Dream Ahead side, but keep in mind that there are times when investment returns may be higher than tuition, and then times when tuition might be higher than investment returns. So this is a good example of how one is not better than the other, they're just different. And you really have to kind of take a look at what your goals are and what you're trying to do and what your tolerance level is. And I would even suggest here that a lot of it can also have a lot to do with how old your children are. So if you have very young children like elementary and much younger, even newborn, starting with a GET account is a really great place to be. You've got the opportunity of time on your side with that one. So you open up a GET account and you start saving in GET, knowing that every year as tuition is growing, the value of the account will be keeping up with that. So there's some peace of mind in knowing that as the growth of tuition, and we always hope that it's not going to be too dramatic, but that it's going to be there when you need it to be there, right? But about the time the kids hit end of middle school, most certainly by the time they're in high school, and their window of time is now closer to college age, and so your window, again, I mentioned, is getting smaller and smaller. So that's typically a time when families would stop contributing to a GET account. It doesn't mean that they take it out and move it. They just stop putting new money into it. Let that continue to sit there and grow because tuition is growing each year, right? But now is a good time to move over and start a Dream Ahead account if you hadn't already done that, and now start putting money into that one and picking the type of investment tolerance level that you have. And then when your kids are ready for college, you're actually being able to pull from both resources. So some people have also asked about a time requirement, or how long do you have to use that money that's sitting in the account. Now on the GET program, there is a 10-year time limit, which is from the point that they turn 18 or graduate from high school and would begin using it. So they have 10 years after 18, and then presumably 10 years from when they start using it on the GET program. Now, Dream Ahead does not have any expiration dates because it's an investment vehicle, and so you can continue to be investing the money in there and then having that student use it, or even transferring it to other students at a later point in time. Now, each of the program websites I have on there, and so you can certainly get more details, more specific details by checking out the website. And this is a really good place to also remind you that any type of investment that you're going to be considering or doing, that you'll talk to, if you have somebody that's already a financial planner or advisor to you, to be communicating with them about this. But also any financial professional should be able to help you with some decisions in making those types of investments. And one of the reasons why we really always want to make sure that we're suggesting that to you all is because your financial planner, your financial professional will have an understanding of your bigger picture, and they'll know the other things that you are already doing or would be considering doing, and so how to implement a 529 plan along with that. So always keep that in mind. Now, the things that are the same, and I mentioned this earlier, is that the earnings, whether it's a GET or Dream Ahead or a prepaid or a traditional savings, the earnings are going to grow tax-free, and as long as the kids use it for educational expenses, eligible expenses, they stay as untaxed. Where the students can use them, that apprenticeship program is a new feature and really exciting because there's a lot of students who are looking towards the trades, that kind of thing. So now you can use that money to cover expenses there. And then, of course, if anyone can contribute and you are able to transfer money between beneficiaries in 529 plans. So I noticed that there may be a couple of questions. I have one. I'm going to take some time right now to answer it. When did they stop putting money in a GET account? Sorry, I missed that. Okay, I'm going to answer that one live because I don't want it to get too far before we come back to it. Now, when I said that, typically speaking, a family would stop about the time the student hits high school. It's not a requirement, right? It's just when you're looking at how close your student is getting to college age, typically speaking, a family would stop contributing to get around that time that that's certainly a freshman in high school, because the window is closing a little bit, and as tuition is growing, you may be not losing some time, but your time frame it's not going to be sitting in the account long enough for it to grow fast enough. So that's why we suggest starting the other type of 529 plan. So in this case, Dream Ahead, about the time the kids are in high school. We had another one. Given times now, economy, it appears to me that GET might be better for a student who is now a freshman. Risks should be conservative. Okay, I'm going to answer that one live too. So, because I was just talking about this part of it and I think the next slide, when I get into it, is going to describe a little bit about one of the major differences between GET and DreamAhead 2, and why the suggestion would be that if your kids are already in high school, that GET may not be the plan that you'd want to consider at this point in time. So let me go to that slide, and then we'll come back to some of these questions in just a moment. So the next slide is going to be a little bit deeper dive into understanding how GET and DreamAhead work. So let's just start with the GET side of the house first. So the GET program works on what's called a unit system. And sometimes people have misunderstood the word unit to be assumed as a credit hour. And that's what students earn academically when they're enrolled in a college, in the college environment, right? So for the GET program, a unit is really just a form of measurement. It is not equal to a credit hour. Those are two different things. So our form of measurement is called units, and we actually start at the baseline of 100. So 100 units represents 1 year of time. Now, when you open up a GET account, you're going to choose between what's called a lump sum plan or a custom monthly plan, and I'll talk about that more specifically in a moment, or a combination of the two, as a way of contributing or purchasing these units and having them build up in your account. Now, the key thing to remember, though, about these units is that the unit price itself will change from year to year. Now, there have been times when the unit price didn't change at all, or it changed very little, but there were also times when it changed a lot, and that had a lot to do with tuition. So as tuition increases, the unit price has to increase as well, with the future expense, right? So you're buying these units. This year's unit price is $121 a unit. So if you were going to buy 100 units at this year's price, that price will expire on June 25th, actually, is the date that that price expires. The committee meets later in the summer, and then a new unit price is approved and determined for the next enrollment period, which would start in November. So if you were to buy 100 units, you'd pay $12,100 for them. So in this example, we bought that now, and then let's presume that 10, 15 years from now, your student is going to start college. And if the cost of tuition at WSU in 15 years is $20,000 for the year, then the 100 units that you paid $12,100 for are now worth $20,000. And that's what you draw from. Remembering that's what 1 year is worth. You draw from that to pay for the eligible expenses, no matter where your student is attending or what their pathway is. You're drawing from what you have in your account, right? So now, kind of piggybacking on that question about why would we stop about the time the student is a freshman in high school, is because if the unit price is $121 today, but the cost of tuition is actually just a little over $10,000 today at WSU, those two numbers are never going to be the same. It's called the purchase price and the payout value. Those two numbers will not be the same. So when you buy your units, it has to sit at least 2 years before it's going to be used. But a lot will also have to do with when it's being used, or when how close the student is going to college, and when you intend to use it. So if tuition isn't increasing very much, 2 or 3%, if you buy it at $121, you have to believe, or the expectation would be that in relatively a short period of time, the cost of tuition is going to be equal to or greater than what you bought it for. So that's why we always have people consider that at about the time the kids hit high school, you wouldn't want to be putting new money into that. So I do see couple of questions here. Okay, so I will get to those questions, no worries. I am not losing them. I just wanted to make sure that people know that I do see them. Okay, so now let's get back to what I was talking about with GET and the GET program. So the lump sum plan is really a way of just putting money into an account with no, there's no requirement to do anything specific. So an example here, and I did this actually years and years and years ago when I set up accounts for my 2 boys. I got accounts open for them. They were lump sum plans, and I made the decision to put $100 a month away for each of them. Now, it didn't matter what the unit price was at the time. I was buying units at whatever the price was based on the amount that I put in there. So you can see in this example, if the unit price is $121, but I put $100 in, I'm not accumulating a whole unit, but it's $100. So every time money goes into an account in lump sum, it's accumulating units or portions of units. Now, most people, when they're choosing lump sum, it's because it's got great flexibility. You can put in what you want when you want. We always encourage people to do things on a regular basis, like choose to do something monthly and then increase it if you can. Take a pause if you have to. If you have to decrease it 1 month and do more, that's the flexibility with the lump sum, is that you can put in what you want when you want. And then anybody else who's deciding to contribute, like grandparents on birthdays, holidays, or even if they're doing it regularly, that money goes in and just accumulates portions of units and helps to build up the account. Now, the custom monthly plan is a very structured monthly payment option. So when you open that type of a plan, and on the open account link on the GET website, there's another link that says explore options, and the payment chart would be in there. But with the custom monthly, you're actually electing to buy a chunk of units. So they come in increments of 50. So you could do 50, 100, 150, anywhere between 50 and 800. But you're electing to buy a chunk of units over a specified period of time, and you have a monthly payment that you are locked into, that you will pay every month for a period of time that you have elected. And then you will have that many units that you contracted for at the time that your payment cycle stops. Now, the thing with the custom monthly plan is that your price is locked in, or not your price, but your monthly payment is locked in. It doesn't change, even though the lump sum price every year will continue to change, right? So that's going to be different. Now, on the custom monthly plan, part of your monthly payment includes a finance charge because it's being financed over time, right? So some people will do a combination of the two. And in fact, with my youngest son, I did that. A couple of years after I had his lump sum plan going on, I opened up a custom monthly plan for him. So I was making a very specific monthly payment for 100 units. And then all the lump sums that had been purchased were still there. And then as my family, my mother, in fact, was contributing every month. She just sent set number of dollars every month she sent to my kids' accounts. And so the lump sums were coming in, and it was a combination of those two efforts that then had a set number of units for my kids when they were ready for college. So the GET program will have a maximum number of units per beneficiary is 800. And then the student can use up to 200 units each academic year, or what you have, plus anything that's rolled over from a previous year. So that's how the GET program works. I'm going to pop on over to DreamAhead because that's a little different. Now, on the DreamAhead side, there's no units, no mention of units. You're not purchasing units. You're making an investment. So you're going to check the portfolio offerings that you'd want. And again, you're remembering that this looks a lot more like your retirement type of savings accounts, right? So you choose from a variety of different portfolios. There are two basic types, which one would be year of enrollment type of portfolios, where they will automatically adjust the investment strategy based on the age of the child. So it will automatically happen as they're getting older. And then there's the static. which stays the same. So your investment strategy will always stay the same, but you have the ability to go in and make changes to it from time to time if you choose that you want to go from, maybe you were started out high risk and you moved down to conservative. Again, this is a good place to remind you, to always confer with a financial professional about the investment choices that you're making so that they can help you fit things together with what you're doing already or plan to do along the way. And then, of course, there's a combination of the two portfolios. Each of the websites have very specific, like, this is how it works, and different pricing information that you want to look at. Now, minimums and maximums, minimums and maximums, you can have up to $500,000 contributed into a DreamAhead account if you have just a DreamAhead account for your child. But if you actually had, for the same beneficiary, a GET and a DreamAhead account, it would be $500,000 between the two plans there. So initial contribution amount for a DreamAhead account is at least $25. And then as you're doing ongoing contributions into a portfolio, needs to be a minimum of $5 per portfolio. Typically people do more than that, but that's the minimum. On the GET side of the house too, if you're gonna be doing a lump sum plan, you have to purchase a minimum of 1 unit in the first 90 days. So right now it's the 121, so divide that by 3. That 121 needs to be landed into the account in the first 3 months, and then thereafter you can contribute as little or as much as you want to at any given time. Again, the encouragement here is to do something on a regular basis so that you've got something that's building up that account regularly. So now I'm going to take a look at some questions. I want to make sure I don't get too far away from that. And I hope, Pam, that I was able to answer that question that you did have, but let me know if you have more. Next question was, is there any scenario where the GET price is less from last year, or is it always increased? And actually, there was a time, I'll answer that one live. There was a time in 2015 to 2017, the legislature reduced tuition. And so the program, the GET program at that time went on a hold, and we weren't taking any new enrollments while we did some pricing restructuring. So we had to do some automatic refunds to some folks. Other people chose to take refunds and move money to a different 529 plan. And at the time, we didn't have DreamAhead opened yet. That actually came out of that legislative decision, but some people chose to move out, but we did pricing restructuring. So when they bought units at a higher price in the restructure, their unit price dropped. But then about 2 years after that, once that 2-year time frame had passed, the payout value then did decrease because tuition had decreased. And by law, the GET account can keep pace with the tuition, what the actual cost of tuition is. So we did what was called a rebasing process. And so some people chose to transfer their money over. At this time, DreamAhead was now open. They did a rollover to DreamAhead. And then other people chose to stay and had extra units added to their accounts. So there was a scenario, Amit, where the unit price had decreased and so had tuition. But the program had certainly demonstrated, along with the committee and the legislature, the commitment to the securing, making sure that people were whole, that there wasn't unexpected decrease in value. So the rebasing process allowed people to either transfer to DreamAhead and have a bump up in the value, or to keep their GET account and have extra units added to their account. So I think I answered those two. Let me check this one. Can a city employee pay through automatic deduction from a salary? And thank you for that question, because the answer is yes, they can. In fact, payroll deduction is an option, an opportunity for employers to set that up for their employees. And we work pretty heavily in trying to get this information out to employers, including cities, city states, government entities, public and private organizations, to provide a payroll deduction process for their employees. If you're a city employee and you're wondering if your city is currently doing that, we have a link on our website that lists all the companies, organizations who are doing that. I can certainly reach back out to you and let you know. If you could let me know what city you're in. But if your city or your employer is not actually offering payroll deduction, you could just connect that, reach out to me, give me some contact information, and I can reach out to them and give them information about how to get that set up for you. So the short answer is yes, it can, and we'd be happy to work that out for you too. Investment fees for DreamAhead. So I'm going to suggest, Peter, that on the DreamAhead website, there will be a link to the fee structure for the DreamAhead plan. Let me know if there's something more specific I can help you with. Seattle Public Schools. Okay, you answered the question about the employer that you're working with. I think that was you, Sherry. So I will check on Seattle Public Schools. If you can get to the website, I will do my very best to point you in that direction so you can check the link and see if Seattle Public Schools is on there. If not, I'll reach out to you separately and we'll get that contact information over. Okay. So I've answered some of those questions. I'm going to now take us into the area of how do I get my money out of my account now? So many times as you're saving money in a 529 plan or any way that you're saving, it's going to be sitting there for quite some time. And then how do I get my money out and get it then moved over and sent to the right places? And so the answer to that is as simple as bill pay is to us all right now, and something that we're probably all pretty accustomed to. So getting money out of your 529 plan and then so that you can start to use that money, you would log in to your GET or DreamAhead account. And if you have another 529 plan, they follow the same typical processes, but you would want to check your own plan's website for specific details. But typically you log into your account and you initiate either a direct payment request where you're telling the program to directly pay the institution. And typically that's for tuition, fees, and on-campus room and board. And you identify what it is and how much it is and submit, and then the program will take care of getting that payment off to the institution. The other way is called where you initiate a reimbursement request. So it may be things that you've paid out of pocket like books, required supplies, but even tuition, fees, room and board, whether it's on or off campus, anytime you've spent money out of your own pocket for eligible expenses, even if you didn't do a direct payment request, you can request reimbursement for the expenses, and then the payment will come back to you or the student, however you designate that to be. The thing to keep in mind, though, is you should always be keeping copies of your receipts for whatever the expense was, and then the distribution request. You want to make sure you hang on to those things. If the IRS audits you, you'll have to be able to show the distinction between the expense and then the distribution. And then the other thing you want to always try to line up is that when the expense occurred and when you request a distribution out of the account, that those happen in the same calendar year. So for example, if your student was enrolled in college in the fall and you had a tuition bill, you wouldn't want to wait till the spring of the following year to either do a direct payment request or even do a reimbursement request, because you have now crossed over tax years. So you're going to want to make sure that you stay with the distribution and the expense within the same calendar years. I do have a resource for that on one of the slides at the end of the page too. So I'm going to take a look at a couple of questions here. You are very welcome. And what type of apprenticeship program requires tuition? Well, I'll tell you, we are all 529 plans are going to be new to the apprenticeship world, because that bill that allows money to be paid towards apprenticeship programs passed in December. And so it's still relatively new for all of us. I guess the best answer here is to certainly take a look out, and I'll have a resource on one of the slide at the end of the presentation with the apprenticeship program. But if there are expenses that are required for the apprenticeship program, and sometimes the apprenticeship program will require the student attend a class in a classroom setting at a community college, for example, we may be paying the tuition at that community college for that, right? But you can also, my thought here was to tell you that whatever the expenses are, as long as they're eligible expenses, whether it's called tuition, fees, room and board, books, or required supplies, again, as long as you keep record of that, you can be requesting reimbursement out of your 529 plan. The money comes back to you. I hope that Christina, that I was able to answer that in a way that you were expecting it. But if not, let me know, because I can get you another resource and connect with you afterwards too. And Cherie, my colleague, did double check, and she said that right now Seattle Public Schools is not currently registered to offer payroll deduction, but we can reach out to them and get them the information and resources to help them make that decision. And let me know if there's anything else I can help you with as we begin to communicate with them about that as well. Okie doke. I'm going to take us now to the top 4 what ifs. So these questions come up pretty much all the time about scholarships. Like, what if my kids get a scholarship? What happens with the money that I've set in there? Or my kids say that they're not going to go to college. And so sometimes people are hesitant to even start saving because of they think, well, if this happens or that happens, then maybe I will have done this all in for no reason or in vain. And what I want to tell you here is that, first, if your kids get a scholarship, let's congratulate them on that, because that's a really good thing to do. But the other thing is that you can consider other things that might need to be paid. So a scholarship might only be conditional. It might only cover tuition or fees. So is there room and board that might need to get paid? Are there books and required supplies? There might be a possibility that the student won't get the same or as much of a scholarship in the following year. Will you need to hang on to the money and use it later? Is there another family member who you could transfer some of the money to so that they can benefit from that? You can also refund money from an account, even based on a scholarship. And I'm going to talk about refunds in a moment, right? But then if the kids say, well, I'm not going to go to college, one of the very first things that we would suggest is to think about first, what is their pathway? Remembering that it doesn't have to just be used at a 4-year public or private institution, right? Community, technical, and vocational schools, and we talked about apprenticeship programs. Those are viable higher education pathways for students. So it doesn't just have to be that 4-year public or private kind of experience. So first think about the pathway and whether or not you have the opportunity to be using the money to pay for expenses there. The other one is waiting. The kids might say, I've graduated from high school, I'm taking some time off, or just give it some time. They don't have to use it immediately. You're not required to be taking that money out or sending money off as soon as they turn 18 or graduate from high school. So wait it out a little bit and think about what the student might be planning to do in the near future. Again, you can also transfer to other family members or take a refund. The thing I want to mention about refunds, and this would be the case of any money in any 529 plan, is that it's been growing tax-free as it's been saving. You've been contributing and saving. But if you take the refund, the earnings portion at that point becomes taxable, and the IRS can also impose a 10% penalty fee on the earnings portion. Now, depending on the plan that you have, plans may also impose additional penalties and fees on the earnings portion. So you're going to want to take a look at your plan's cancellation and refund policy to be sure what that might be, if there are any, right? So before you take the refund. So first thing we always suggest if you're thinking about refunding is think about other things that might need to be paid first. even transferring. But if you need to take the refund, most certainly, take advantage of doing that, but also understand that the tax implications and any penalties and fees, whether the IRS or the program, are on the earnings portion of that refund. So if your kids say that they're not going to go to college, think about those couple of things before you initiate that. Now, if your kids, your kids, somebody's moved out of state, you can certainly still contribute and withdraw the money as if you were still living here in the state of Washington, right? So there are students that are attending colleges all over the country and even abroad right now who previously lived here in Washington and now live somewhere else and are just drawing money from their accounts to pay their expenses. So the movement, that whether the family moves or even just one of the student moves, is not a big something to overly be concerned with. One of the things I would mention here, though, is to keep in mind, particularly with the GET plan, is that the value of it is keeping up with in-state undergraduate tuition of the UW and WSU. So if you have moved, your student has moved, and then they choose to come back to Washington and attend a college here, and they're now being considered out-of-state, with out-of-state tuition amounts, your value of your GET account is not keeping up with that. It's keeping up with undergraduate in-state tuition rates of the UW and WSU. So just keep that part in mind. And then, of course, if your family situations change, and we've seen that happen over the last several months, given the stay home, stay healthy order and the pandemic and the different things that are happening with families. And we want to be responsive to those different situations. So if something is happening and you have been saving money and you're considering like, oh my gosh, maybe we need to stop or pause, or what should we do? We always encourage you to call in and talk to a representative at your plan. So whether it's GET or DreamAhead, when we're talking about our two plans, and just talking through with that representative who can look at your account and give you some ideas of what maybe some options would be that you could consider that help you still retain the account that you have, or maybe taking just a short pause on things. So there are options available. In fact, we have seen where some people have started out with a custom monthly plan. Remember when I mentioned that one is a very structured monthly payment, and they needed to make some adjustments. So some people have converted it to a lump sum plan, so they're not under commitment to make any regular contributions, but they've retained everything that they had already previously purchased. So there are things that we can talk about. So just call in and talk to a plan representative. I'm gonna move, before I move into the next slide, which is talking about financial aid, I want to take a look at some cute questions that popped in. So I had a question: if I open an account for my son, but if he will not use and you want to transfer to kids or grandkids, is a good option. But what is time period to transfer? Oh, well, there is not necessarily a specific time period when you decide to transfer. It really depends on your situation, your children or grandchildren, or when you need to do that. So let me give you kind of an example, and this is one that I did. So when I was saving for my own kids, I had, I would put money in their accounts. They're set this money. They used it when they needed to use it. But then here it was still sitting there. And remembering with the GET program, you have a 10-year window. So once the kids are 18, you have 10 years to make a decision on, whether this student's going to use it or you need to transfer it. And then they have that student or another student has 10 years from that point in time. So you've got a good amount of time before you have to do something specifically. So what I ended up doing is I just let that money sit without doing anything with it, because remembering that it continues to grow, right? And my anticipation was at some point, maybe there will be grandchildren. And then when my children got married and had their own children, then I was able to just do the transfer. Now, the key to a transfer is that it has to go from a place to another place. So my own children had to set up their own GET accounts for their own kids, and then I just initiated a transfer. So Ahmed, I hope that helped with your question. But please feel free to let me know if there's more to it, and I can answer that. Is there a minimum payment when there's an emergency or a hardship? Now, I I'm thinking that that question might be referring to if you have, specifically on the GET program, if you have a custom monthly plan. So with your custom monthly plan, the expectation is that you're going to make your monthly payment every month for the duration of the time period that you set up. So let's say you decided to make payments for 10 years. So the expectation is you're going to make your monthly payment every month for 10 years. But there comes times when something happens and you need a pause or a break or whatever. So there's not going to be technically a minimum or even a maximum. You would call in and talk to the contact center representatives, and they will look at your account specifically. But there has been times when people have taken a pause on making their payments and you're not incurring any late fees when you call in and make sure, and then our contact center teams are helping to make sure that you've got a plan in motion for how to catch up later. And so what would happen is that after you're able to start picking up those payments again, it would be incorporating some extra to get caught up. So that's an option. That's just one of many types of options. In fact, we do have a webinar that was recorded from a week, maybe a little over a week ago, when our contact center manager was actually talking about the various options for custom monthly plans for making changes to an account. So that might be one, Cherie, that you might want to listen to. It was like 20 minutes, 20-minute webinar, 30 if there was additional questions, but I think that one should help. And then there was, thank you for the information. They will check out the other webinars. So you're very welcome for that. So now I want to jump into talking about financial aid and 529 plans. Now, before we talk about the 529 and financial aid piece, I want to just kind of get a good picture here of understanding financial aid in period. So first of all, when your kids are graduated from high school and they start applying for colleges and institutions, they're going to fill out the FAFSA form, which is the Federal Application for Free Student Aid, right? So that's where there's going to be the beginning parts of determining what kind of grant or aid your student is going to qualify for and how to pay for their college experience. And so the financial aid actually consists of 4 types of things, which is going to be grants. Typically, grants are things that would not be expected to be paid back. However, there might be situations in which that money would need to be paid back. But they're income-based, federal, state, and institutional types of grants. Scholarships, the student can get a scholarship, whether it's from a merit-based type or from an institution. Even local banks and clubs and programs will have a lot of different kinds of scholarships students can apply for. Then there's work study, and then there's always going to be loan opportunity. And those 4 things generally cover how you're paying for your students' educational expenses. But the thing that needs to be slipped into all of this is savings, right? Because any money that you can save, and whether you're saving in a 529 plan or any other way of saving money for their educational expenses, that savings component is going to offset what the student could be getting in the form of loans, right? They may still receive grants and scholarships and work study, but you're going to have the savings component. That's why this is so very important, to offset how much potentially the student would end up having to borrow. So any dollar saved is a dollar less than they're borrowing in the future, right? So this is why it's important to think about how savings will fit into that financial aid picture. Now, what comes up quite a bit is the consideration of what is this money, how is this money impacting the kind of the financial aid that a student could be qualified for? So what I want to share here, and I'm being really specific about financial aid, 529 plans and financial aid, there are things to consider if you've got money saved in other ways, like if it's an UGMA or an UTMA type of account, I'll mention that in a few minutes too, or if it's a Roth IRA, or even if you've got property or other ways that you're saving. Those are things that you're going to most certainly want to be talking about with your financial planner professional, so that they can help you figure out or understand the impact of financial aid on those types of savings. So right now I'm specifically going to talk about 529 plans. Now, oftentimes I've had people say to me, well, if I put money away or I have this money saved, my kids are not going to qualify for financial aid. And the answer to that, in short, is actually that it's not that they're not going to qualify for financial aid, because remember in that other slide, we talked about the different types of financial aid, right? But what it may impact is just how much in need-based financial aid the student would qualify for. So the goal here is to make sure that your student has more opportunities for grant types of financial aid. Not that it's all going to be grants, but that they have more opportunities from that. And that happens through the difference between income and assets. So if you have money in a 529 plan, and you as a parent specifically, or that student who is still dependent on you, owns that 529 plan, it is considered a parental asset for EFC purposes, right? And they only calculate up to 5.64% of all the assets to determine the EFC. So that means that's a way better comparison. As you can see, moving down, if the student is independent of you, and they own their own 529 plan, but they are not dependent on you, then that money that sits in their 529 plan would be considered income, and then income is calculated differently in terms of the EFC. They calculate up to 20% of the income to determine the EFC. And then we go further down where if a grandparent owns the 529 plan, or the non-custodial parent, or even anyone else who owns the 529 plan on behalf of the student, once the student starts to draw the money or need to use that money, if any one of those other groups of people are the owner of the 529 plan, it could be considered income to the student, and then they calculate it up to 50%. Now, I want to make sure that what I'm saying here too is that this is not a chart to describe what not to do. I mean, if you're saving in a 529 plan and a grandparent is doing it, that's a great thing. That's not a bad thing. But it might be something that they consider changing the owner of the account to the parent or the student when the student is ready to start using it. And we've seen that happen quite a bit. There's nothing that prevents you from doing that. And in fact, that was something that I considered when I was contributing money to my grandkids' accounts, right? As the grandparent, as long as the parent is the owner of the account, then it's going to be considered a parental asset, irregardless of whether the money was coming from me or somebody else in the family, right? So those are things to think about and consider. A good resource for this is going to be the collegesavings.org website that I talked about, but the FAFSA website as well gives some good resources on this, and collegesavings.com. You can even Google 529 plans of financial aid and get some really good information and really good solid resources about that. The other thing to keep in mind is that financial aid rules change. So if you've got a newborn today, don't hang your hat on all information until your kids are getting closer to college age. Just consider things like that. This is information for resources and certainly to things to consider, but not all things are going to be the only thing to consider. So I wanted to make sure that I mentioned that. So here's a couple of slides too on other ways that people save. They're not, again, I want to make sure that I'm saying here, these are not, just because these are what they are doesn't mean that you couldn't be doing them alongside a 529 plan. In fact, just that whole financial aid piece it describes a really good opportunity for a 529 plan to be your foundation for college savings or educational savings. And then if you're doing other things, like you have a Coverdale ESA for your kids, or you have a Roth IRA that you were considering using for college expenses, or you've got your kids have an UGMA or an UTMA or that kind of, other ways of saving. All those are additional resources that help in the savings process. The idea here is to diversify and not to consider doing that one thing is the only way to do it. So with the Coverdale ESA, those are called educational savings accounts. Most often when people have done that, I think they've really focused on using them for K through 12. There's annual limits, no guarantees on the value. The value of the portfolio will determine the value of the account. So that's just some resource information there. I'm not going to actually read through all of them. Now with an UGMA and an UTMA, and if most people have not heard of them, it stands for Uniform Gift to Minors Act or Uniform Trust to Minors Act. And in essence, These are accounts that you set up through a brokerage house or a mutual fund that the student themselves, whether they are a minor or not, own that account. They are the owners. It's their money. They can do what they want with it when they're of age, the age of majority, for wherever you have set that up for them. They can use it for college expenses, and they can also use it to buy a car. So in and of itself, if it's an UGMA or an UPMA account, there's not going to be any guarantee on the portfolio value at the time that the student needs to take it out. So again, these are just different ways that other people have also saved. Again, not only the only way. And then, of course, the other one I wanted to highlight was like a Roth IRA. So some people have the Roth IRA and they intend that idea is that, well, I can also use this for my kids' college. And it's not a bad way of thinking. They are typically self-directed investments. They have stricter contribution limits. Again, talk to a financial advisor. That's not my area of expertise, so not something I would give advice on. There are different tax considerations when withdrawing it for higher education expenses, including the financial aid issue. So I want to make sure that I'm saying here again, too, it's not the only way of saving, but it's just things to consider. Gerber Life College Savings Plans. We've heard of a lot of people who have purchased those. Those are actually intended to be life insurance policies, not college savings plans, but some people have put them away with an idea or an expectation that it could also pay for, some future college expenses. Certainly not a bad thing to do, but not the only thing to do. Now, some tips for successful savings always start with being regular, right? Doing it regularly, doing something on a routine, trying to be as mindful and specific as you can be, but knowing that, you have to make some flexibility accommodations here and there, so when you can do it, and one of the things, as I say this, I was thinking about like when my kids were becoming parents themselves and they're young and, in their first jobs, it's just reminding them that everything that they, even if it's little, a little bit goes a long way, especially when you start saving early. So you start doing it and you get into that habit and then you build on it as you go along. And that's the same thing that we think about when we're doing our own retirement. So this wouldn't have to be considered any differently, right? So consider doing something regular, even if it starts small. Do what you can, add to it as you can. Remind your family what you're doing. In fact, we have heard from many customers have reached back out and told us that they included this information like when they were doing birthdays or even baby showers, so that the accounts start growing even before a child was even born, which you can do. And let me know if you have a question about that. Consider additional ways to save and supplement what you're doing. We talked about that just a few minutes ago. And then as your kids are getting closer to high school, certainly that freshman year in high school, is start exploring scholarships and financial aid information really early so that you are really clear on what it is you need to do and the considerations that you need to make, so that you're not waiting until the student is a senior in high school and you're trying to make all those decisions in 12 months, okay? So I'm going to take a look at the questions. It looks like we've got pretty much all of them answered. I'm going to look again before we finish up. But I'm going to take you, because we're really reaching the end now of the presentation, and getting started is as simple as gathering the resources. And this was a really good step for all of you that you joined into this webinar to learn a little bit more about GET and DreamAhead. But you gather the resources, you can open accounts up online. Each of the websites has a link that says open an account. There are no enrollment fees for getting accounts open. Again, as we talked about earlier, you get those accounts open and you just start contributing to them. Tell others, let your family and friends know what you're doing and let them help build those accounts out. And then certainly reach out to us and let us know how we can help you. If you've got questions that aren't being answered or things that you need a little bit clearer understanding on, let us know how we can help you with that and get those resources to you. And speaking of resources, this one is pretty tight here. I kept finding some things that I felt like I needed to share, but we've got certainly the GET and DreamAhead websites there. Our agency, which is the Washington Student Achievement Council, is the parent agency that administers the GET and DreamAhead plan. But they also have information about financial aid, about College Bound, a scholarship program, the Washboard, which is a free service that connects students to scholarships. We've got resources about the FAFSA form and your students applying for college. There's a program called the 12th Year Campaign that will help when your student is actually a senior. So take a look for that. The agency also has the College and Career Compass tool for adults that are returning to complete a degree program. So that one would be very useful to many people. I mentioned IRS Publication 970 when I was talking about taxes, so that would be one that you want to refer to. The apprenticeship programs. Washington Career Bridge also has a one-stop source for career and education planning. That would be helpful. And then the FAFSA website, the one at the very bottom, is actually a link. It's not a very clean one. I should make better use of how I did that. But it is the website that you can go to do a search in an area of all the schools that have a U.S. federal ID code. So that comes up when people are, particularly when people are interested in knowing what schools or institutions abroad in another country that they could use their 529 plans with. But this will help for any community in any city, state, and foreign country. So that's a great resource for you there. So I think I got through all of the questions, but I'm gonna double check that some came into Q and if any came into the chat box too. So there was a question, I think, from Christina. If you go to apprenticeship.gov, you can see if the apprenticeship program is registered. Whether or not they have tuition is an individual apprenticeship thing. That was what Liz, my colleague, was able to search out while we were talking. I'm not seeing any additional questions that I haven't already answered. You are all so very welcome thank you. I really should be thanking you all for being here with me today. On our website, we have a calendar of events, and we have been hosting what's called the WA529 Knowledge Cafe. And this is an online meeting opportunity just to talk about the questions that you might have, or scenarios or situations or things that you're wanting to know about GET and DreamAhead. That maybe you haven't found on the website or just would rather have a dialogue about. So the Knowledge Cafe is open every day, Monday through Friday, during the month of May, as we're leading up to the end of the GET enrollment period. So there are some days that it's at 10 a.m. and some days that it's at 3 p.m. So take a look at our calendar. If there's other times that you want to chime in and get some more information. We will be talking about different topics too, not just the basic GET DreamAhead information, but we'll be digging a little bit deeper and doing some conversations around like 529 plans and financial aid, or how to use your units. In fact, we're getting ready to start a webinar on, starting to use your units or the money sitting in your account. And we're going to spend a little bit more time in looking at how that process works and, from beginning to end. So take a look at our website for other dates and times that we'll be hosting different interactive opportunities to meet with people. So with that, if there are no additional questions, I would like to just say thank you again for joining me, and have a good day. Everybody take care and stay safe.